To prepare for Twitter's fourth quarter results this week, we're going to take a look at the guidance that management gave us last quarter and see how that compares to consensus estimates. For this video, we'll be using our Twitter earnings model. If you'd like to download this model and follow along as we go through, please visit our website, gutenbergresearch.com, and click on the Free Models tab and find the Twitter earnings model. And if you're new to our approach, be sure to download our modeling approach and valuation document here from the homepage. Just click to download. And if you'd like to get the details that we discuss here, it's in our model blog. We kind of highlight each one of the items that we're going to go through, and you can also download the model from this page as well. So now let's take a look at the earnings guidance that management gave us. And we'll start on the revenue side. So for Twitter, there's a number of things to think about in revenue. We have kind of this divergence between the consumer products and the advertising initiative. So on the consumer product front, there's been a lot of developments over the last quarter. We had the Twitter Moments launch, highlights on Android, music on Vine, web profiles on Periscope. They also changed the 140 character limit on direct messages. And then we have to think about how that's going to translate into actual earnings. And there are some important new items on that front as well. So we had the video autoplay, which as of the third quarter of 2015 decreased advertiser cost per view by about 84%. And it resulted in video completion increase of 7 times. There's also a new optimization and bidding enhancements for performance advertisers, which has lowered costs by about 20 to 30% as of 3Q15. And they had the launch of the new ad editor last quarter, which allows advertisers to create and edit multiple ad campaigns at one time. So the impact of these developments is extremely difficult to translate into our revenue forecast, but we basically attempt to do it with a simplistic approach of disaggregating monthly active users between the United States and international, and then following average revenue per user trends that we've seen in the past. So it's those two key metrics that drive our top line revenue estimate. So one important thing to note here is that we're not actually breaking out our monthly active users and average revenue per user by desktop and mobile applications, but it's actually a less important metric for Twitter than other companies such as Facebook, because Twitter has said that as of 3Q15, 80% of their monthly active users were mobile, and 90% of revenue generated was also mobile. So we don't really feel the need to disaggregate it from that perspective. So you can see in our top line revenue estimate, we've colored this cell orange, and that indicates that it meets consensus estimates. So 710 million is the consensus estimate heading into the fourth quarter. And the way that we get back there is we had an increase in monthly active users in the United States of about 1% and 2% international, so it's about 1.8% overall. And our average revenue per user increased in total by about 23% in the fourth quarter from the third quarter. And that is down from a sequential increase of about 31% in the fourth quarter of last year. And you can see those metrics back here in our historic details. And that's really just recognizing the fact that the owned and operated revenue has actually declined, or the rate of growth has declined last quarter. So we think it's appropriate that we have an average revenue that's also declining. And we can compare that revenue estimate to what management guided. So they gave us guidance of 695 to 710 million. So this 710 million represents the high end of that guided range. Next, let's talk about some of the puts and takes that go into the adjusted EBITDA estimate. So management gave us guidance of 155 to 175 million. And we'll start with the gross profit, which in this case includes the traffic acquisition cost, the TAC. So you'll note if you follow our Facebook model, we actually separate TAC from the other costs of revenue. Here we just have one estimate for cost of revenue to get back to the total gross margin. And you can see that our non-GAAP gross margin represents about 2.7 percentage points higher than last quarter. So that's pretty consistent with what we typically see in the fourth quarter. And then we also included $10 million of restructuring costs in our operating expense. So you'll see that management gave us guidance of about 5 to 15 million of restructuring costs in the fourth quarter. So we just took the midpoint of that range. And then keep in mind that we're actually backing out those restructuring costs from our non-GAAP operating margin, EBITDA margin, and EPS estimates. Another important note from the third quarter conference call was that some of the costs that were originally anticipated to be in the third quarter got pushed and will end up in the fourth quarter, and that's why management's guidance for adjusted EBITDA was a bit lower last quarter than the original expectation. So you can see in our adjusted EBITDA, we're including this $10 million of restructuring costs. We're also including the midpoint of management's guided range of stock-based compensation. So we have 175 million. They guided to 170 to 180 million. So then we get back to an adjusted EBITDA of about 163 million, which is in line with management's range, close to the midpoint. So they guided 155 to 175 million. So that's about all the guidance that management gave us from last quarter. So once we take all those items into account, there's really only a few other line items on the income statement after the EBITDA line. So we have interest expense, other income, and provisions for income tax, which we all kept fairly consistent with trends from last quarter, as well as the diluted share count. So you can see we have a slight increase in overall shares expected. And with those assumptions, we get back to non-GAAP diluted EPS of 12 cents, which is in line with consensus estimates. And although management doesn't give us guidance for the bottom line EPS estimate, we were able to get back to this EPS number using the ranges that management gave us for the items that they do give guidance on. So now that our model is calibrated to meet consensus estimates, we can scroll down and take a look at our valuation assumptions here. So keep in mind that our Twitter model is a tier 2 model, so there's no balance sheet or cash flow statement, and we do not value it based on a discounted cash flow approach. We simply use a market multiple approach. So this is actually a pretty straightforward model. This is an easy one if you're new to modeling to get your feet wet with. And heading into this release, shares are trading at about a 30 times next 12-month consensus EPS estimate multiple, and that's on an ex-cash basis, so we add the cash back after we value the equity. And that gives us a valuation of about $16.50 a share right now. And keep in mind that after the release, we'll keep this multiple constant, and then that way we can kind of isolate the impact of valuation changes simply from the earnings estimates for the fourth quarter and the new guidance that management gives us. Be sure to check back on our blog after the earnings call. We'll update the model and make it available for you to download. And if you're interested in financial modeling, subscribe to our YouTube channel and follow us on Facebook. Thanks for watching.